Chapter 8 Taxes. Tax incidence. Tax incidence is a division of the burden of a tax between the buyer and the sellers. Generally, sellers and buyers both pay part of a tax. When a good is taxed, it has two prices: a price that excludes the tax and the price that includes the tax. Buyers respond only to the price that includes the tax because that is the price they pay. Sellers respond only to the price that excludes the tax because that is the price they receive. The tax is a wedge between these two prices. Taxes are charged by the government in addition to the price of the goods or services. One common example would be a sales tax. Taxes increase the price of the products, which naturally decreases their demand. In other words, taxes can contribute to deadweight loss by making consumers less likely to purchase goods and services. Specifically, this problem arises with taxation when taxes make the product cost more than the equilibrium market price. When taxes on a good or service increase, both producers or consumers must shoulder those extra costs. In practice, this means that consumers pay more, producers earn lower profits, and overall purchases of that good or services decreases. Thus, the outcome is a deadweight loss. This will be illustrated with an example. In both parts of the figure, with no tax, the price of an MP3 player is $10 at equilibrium and equilibrium quantity is 20. With $4 tax on sellers shifts the supply curve up to S1 by the amount of the tax. With $4 tax on buyers shifts the demand curve down to D1 by the amount of the tax. Producers would want to supply less due to the imposition of a tax. It decreases to 15 from 20. If the tax is on consumers, consumers would reduce the quantity demanded to 15 from 20. The price received by the seller falls to $8, a decrease of $4. The buyer's price increases from 10 to 12. The government collects tax revenue of 90, that is 4 times 15, that is the area of the rectangle. In both cases, the burden of the tax is split equally between the buyer and the seller. Each pay $2 per player. Inefficiency and deadweight loss of taxation. Resources are used efficiently when marginal benefit equals marginal cost. Taxes place a wedge between the price the buyer pays, that is marginal revenue or marginal benefit, and the price the seller receives, it is the marginal cost. The equilibrium quantity is less than the efficient quantity and a deadweight loss arises. Taxes obviously lowers the value of transaction to both buyers and sellers in that the buyer pays somewhat more for the product and the supplier receives less. Some of that loss of value goes to the government, which of course is why it collects taxes. Specifically, deadweight loss consists of the loss of consumer surplus for buyers plus the loss of producer surplus for sellers who do not participate in the market, resulting in less total surplus for the economy. This loss of economic welfare consists of buyers who will no longer buy the product because the price is higher than their willingness to pay price, so they decide to do without. Likewise, some sellers will not produce a product because they are not receiving a high enough price to cover their economic costs. The benefit that these buyers and sellers would have added to the economy but for the tax is a deadweight loss of taxation. Because these buyers and sellers do not participate in the market, they do not contribute to the tax, which is why government does not receive the portion consisting of the deadweight loss. Instead, the taxes are paid by the buyers and sellers who continue to participate in the market. The buyers pay part of the tax in an economic sense as a reduction in their consumer surplus. Likewise, sellers pay part of the tax as a reduction in their producer surplus. This loss, however, goes to the government in the form of its tax. The sellers will continue to sell the product, contribute to the tax. Thus, in terms of total surplus, that is consumer surplus plus producer surplus, the deadweight loss equals the reduction in total surplus minus total revenue collected by the government. The figure shows the inefficiency or the deadweight loss caused by the tax. We will assume that the government taxes the seller. With no tax, the marginal benefit equals marginal cost and the market is efficient. The equilibrium price is $7 and the quantity is 12. If government imposes tax of $2, producers would want to supply less due to the imposition of a tax. It decreases from 12 to 10. The tax burden is $2 is shared equally by buyers and sellers. At new equilibrium price, after tax increases by $1 and that is $8, but the net price that sellers actually receive is $6 without tax. The blue box is the revenue collected by the government, which is equal to 2 times 10 is equal to 20. The black triangle is the deadweight loss borne by the economy as a result of tax, which is equal to the area of a rectangle, that is half times 2 is equal to $2. The orange area is the consumer surplus, the pink area is the producer surplus. Excess burden. Excess burden is the amount by which the burden of the tax exceeds the tax revenue received by the government, the deadweight loss from a tax. But because the government uses the tax revenue to provide goods and services that people value, only the excess burden measures the inefficiency of the tax. In this case, in the example, the excess burden is large. We can calculate how large by comparing the deadweight loss with tax revenue. Incidence, inefficiency, and elasticity. In the example of a $10 tax on MP3 players, the buyer and seller split the tax equally and the excess burden is large. What determines how the tax is split and the size of its excess burden? Inefficiency or deadweight loss varies with elasticity. The amount of the deadweight loss varies with both demand elasticity and supply elasticity. When either demand or supply is inelastic, then the deadweight loss of taxation is smaller because the quantity bought or sold varies less with price. With perfect inelasticity, there is no deadweight loss. However, deadweight loss increases proportionately to the elasticity of either supply or demand. The incidence of a tax and its excess burden depend on the elasticity of demand and supply in the following ways. The first scenario is for a given elasticity of supply, the more inelastic the demand for the good, the larger is the share of the tax paid by the buyer. The figure shows the inelastic demand curve. It is more vertical than horizontal. Demand is inelastic maybe because it is the necessity, lack of time. It could be something that doesn't take high portion of consumer income, or maybe a lot of substitutes are not available. In inelastic demand, consumers are not responsive to changes in price. It means percentage change in quantity demanded is much less than percentage change in price. Therefore, prices are going to have much larger impact than quantity size is. Therefore, when producers shift the supply curve to the left because of tax, burden of tax is more on consumer than producer because are ready to take the burden. Percentage of corn demanded is almost same as before tax. They are not dropping off and buying something else. Both rectangular producer and consumer surplus together or combined is the revenue to the government. Consumer surplus receives significantly, whereas producer supply is not affected much, which is below the red price line and above red line. Deadweight loss is not big due to inelastic demand. The second scenario is with respect to elastic demand. In this, seller pays and is inefficient. In case of elastic demand, consumer is very responsive to the changes in price. It may be because of availability of a lot of substitutes, a lot of time to shift to other product, etc. In the figure, when the supply curve shift left, prices goes up, but not that much. But quantity really goes down. As a result, there is a larger deadweight loss and efficiency loss. Burden of tax is shifted on producer than it is on consumer. The total revenue to the government is the both two boxes combined. Producer surplus reduces significantly compared to consumer surplus, which is below green demand curve and above new price line. The third scenario is inelastic supply or seller pays and efficient. In case of inelastic supply, time is a determinant for elasticity of supply. The figure shows that shortened supply curve. Another is perfectly inelastic, that is the immediate period where supply curve is vertical. In this case, producers have very little time in order to shift and react to the changes in price. In the figure, supply curve shift left, prices are going up, suppliers are not responsive to the changes in price, quantity remain unchanged but the tax lowers the price received by the seller. The seller pays almost entire tax. Deadweight loss is less as it is mostly depend on quantity. The outcome is efficient as marginal benefit equals marginal cost. Smaller box is buyer's box or tax incidence and bigger box is producer tax incidence. Combined together is government tax revenue, which is shown in the picture 3. The fourth scenario is elastic supply. Buyer pays and it is inefficient. This figure is a long run supply curve which is horizontal, in which producers has longer time to react to the changes in price, like hiring more laborers, open up a new factory to increase production or supply. Because producers can be more responsive to the change in price, the burden of tax gets shifted on to the consumer. As a result, producers has smaller tax burden. The combined rectangle is the tax revenue. Deadweight loss is large because there is more elasticity. Marginal benefit exceeds marginal cost. Outcome is inefficient.